Thank you for listening to the Real Estate Voice podcast. This is Vernon R.E. Jones, managing broker, owner, founder of Jones Homes, and we have serviced for over 35 years the 7-county Denver metro area and beyond. After a strong spring and promising early summer, July saw home buying stagnate as a result of rising borrowing costs, forcing sellers to slash prices to revive demand. The share of listings with a price cut reached 20% in July, nearly even with last year's levels, after running close to 2 percentage points lower throughout the spring. For the first 6 months of the year, the dominant theme of the national housing market was sellers pricing realistically from the outset to meet buyers where they are to avoid listings going stale. By the end of June, the share of for-sale homes across the U.S. with price cuts was 1.9 percentage points lower than the prior year. However, as summer entered its peak, price cuts picked up as vacationing would-be buyers pulled back and aging listings piled up on the market. We're seeing the housing market run up against some headwinds, especially on the mortgage rate front, with rates hovering around 6.6, 6.7%, at the exact time when buyer demand starts to pick up. So now we're seeing a dip. So while the realistic pricing narrative is still there, the story has weakened a bit recently. On a month-over-month basis, the share of listings with price reductions rose from 18.8% to 20%. At the regional level, price cuts were least common in the Northeast, which were at 13.7%, Midwest 18.7%, where inventory is tight and demand is robust. By contrast, buyers had better luck finding discounted properties in the more well-supplied West and South at 21.9% and 21.3% respectively. Housing data points to early signs of market softening in the Northeast and Midwest, where the share of price-reduced listings ticked up by about 1 percentage point compared to July of last year. A zoomed-in look at metro-level trends revealed that prices were slashed in July on more than a quarter of homes in 12 of the 50 largest U.S. metros, the majority located in the West or South. Portland, Oregon reclaimed the title of the metro with the highest share of discounted listings at 31%, outpacing Denver, who was June's leader at 30.9%, followed by Dallas and Austin, both with 28.3%. There's a couple of seller behaviors that could affect the process. First, some sellers opt to list above market value in anticipation of low offers, or in case they need to pay the buyer's closing costs. Then there are sellers that see their competition selling and feel that their home should catch at the same price, even though they haven't prepared it properly as other properties. While some choose a strategy of listing higher at the outset with the option of cutting the price down the line, all brokers warn you that this approach can be a double-edged sword and keep savvy buyers away, especially in a market with ample inventory. The cons outweigh the pros because sellers take a huge risk of quote-unquote testing the market, only later to find their property with too many days in the market and now becoming the problem house. A buyer will always consider days in the market, and the listing has remained unsold for an extended period of time. They will inevitably start thinking, what's wrong with this home? And why doesn't anyone else want it? Buyers are taking advantage of these metros with widespread price cuts to secure better deals, often to the seller's benefit as well. At the end of the day, a smart seller and buyer can typically find a win-win. We are able to negotiate a lower amount and our closing costs for the buyer to achieve a lower interest rate, which is crucial right now, and the seller is happy since they technically net the same they would with a much lower offer. I would say buyers are facing economic and geopolitical headwinds this summer and going forward, as the ongoing conflict in Iran, which ignited in February, continues to drive up oil prices and fuel inflation fears. During the July meeting of the Federal Open Market Committee, policymakers voted 9-3 to hold the federal funds rate steady at a range of 3.5 to 3.75%, while keeping the door open for potential hikes later this year to combat inflation. The news pushed the 10-year Treasury yield higher, and a day later, the average rate on a 30-year fixed home loans reached around 6.67%, the highest level in a year. While the spring market showed impressive resilience in the face of accelerating inflation and a mortgage rate roller coaster, these conditions may hit differently in the summer, a time when demand typically slumps. I would probably say when we say it typically towards the end of summer is more likely that it typically slumps. Our revised mid-year forecast penciled in mortgage rates around 6.3, 6.4% for the rest of the year. But that view was predicted on easing Middle East tensions. With the Iran conflict heating back up and oil prices at the highest level since May, that rate outlook may prove to be optimistic. Taken together, the monthly housing data paints a picture of a plateauing market, but not one that's outright losing steam. Asking prices for a ninth consecutive month at a near record pace, settling in at 428,950, down 2.4% compared to July of 2025. The typical listing spends 57 days in the market, 1 day less than a year ago, marking the first real annual decline in more than 2 years. While active listing edged up slightly, new listings flatlined year over year after tracking above 2025 levels through the spring. When the weather gets hot, market activity is usually warm with the weather. But as we deal with mortgage rates being at their highest level in over a year, you're finding buyers pulling back and inventory piling up. If you're a seller, it is to your advantage to price your house correctly from the outset. Get it prepared. Paint what you need to paint. Stop leaks where you can. Have the yard situated correctly so it gives a nice, when people pull up, they get a nice, beautiful, boy, look at that house, I'd like to live there. My thought is, being in this business for 35 years plus, I've seen so many stages of houses doing this or that or the other, interest rates. I mean, I think I was doing this when interest rates were 16, 17, 18% and people were still buying. Because remember, your interest rate says the interest you're going to be paying, which is what you'll be able to deduct along with your property taxes. So each situation is different. Feel free to give me a call and let's talk about it. This is Vernon Jones. Thank you for listening to the Real Estate Voice Podcast. We can always be reached at 303-359-8218. And as always, please be safe.